everyone, welcome back to another session. So, benefits of insurance. So, as you all know, what exactly insurance is. So, insurance means a promise of a compensation for any potential future losses. So, actually, it facilitates financial protection against by reimbursing losses during crisis, right? So there are different insurance companies that offer wide range of insurance options, and an insurance purchaser can select as per on convenience and preference. So actually, several insurance provide comprehensive coverage with affordable premiums, as I said earlier. So insurance is what exactly a cooperative form of distributing certain risk over a group of person who are exposed to it. Have an example: vehicle insurance. Who will take? Those who have vehicle having a risk, they will contribute, right? It is a cooperative form of distribution, so it is called as distribution of risk, right? So we 10 people have a risk of handling vehicle, so we'll contribute a small amount of money. If anything happens to anyone among this 10, definitely the money can be used. So we learned about primary functions also. Next, what is the benefit of insurance? Then yeah, so the benefits of insurance is like a benefit of insurance to the individual, and benefits of the insurance to the business, and benefits of insurance to the society as well. So benefit of individual, definitely peace of mind. We'll get a peace of mind, right? If you are insured, definitely we would get a peace of mind. That is like there is something which help us to bear the risk, or we'll get some compensation, we'll get some damages. Okay, insurance company will indemnify our damages. All right, so that is called as peace of mind. Then aversion of risk, that means we can overcome the risk when we you know take an insurance policy, depend upon the risk. And insurance is a tools of saving. Have an example: retirement plan. Jeevan Sukanya, it is for girl child. So if the girl child become major and she wanted to go for a higher studies, definitely at that time this savings can be used, insurance saving can be used. So this is the benefits of a individual by insurance. So benefits of insurance to the business, definitely marine related losses comes under business. So loss, we can control the loss. Have an example: machinery, wear and tear, damages of a machinery, accidents, fire, theft, right? Theft due to pyrites, fire or due to oil spill. We can reduce credit risk also. Credit risk also. That means insurance will be covered for our credit, that which we have taken from some financial institution. We can reduce the cost of capital. How? Have an example: if you want to repair your machinery, definitely we can we can cut the cost. Insurance company will pay for that. Have an example for car. If anything happens, definitely it will what? It will compensate. Insurance will compensate. Then cost of capital, reduced cost of capital. Yes, exactly. Like if you want to sell that car, or if you lose that car, you will get a depreciable amount, a depreciable amount by the insurance company. If the car has gone for a total loss, you will get a depreciated amount. That solatium you can use for buying another car. Next is benefits of insurance for the society. So it protects the wealth of a country, helps in economic growth, it controls the inflation. So next, why insurance? Like every business is exposed to different types of risks such as fire, theft, burglary, accident, etc. So burglary is what exactly? It's a kinds of extortion or dacoity. It's another form of theft. So every business, right? Every business is exposed to this, right? Flood is there, health is there, right? Health of the employees definitely affect a business. So some of the risk can be transferred to specialized institution known as insurance company. So the the business can give certain sum of money, or business can insure certain uh, things like machinery, property, products. Okay, transit product. Have an example. Shipment can be insured. You are sending 100 cars to US from India. So that container you can insured with the different things like a accident, you know, theft, then fire, burglary, whatever it is. So next is insurance is what exactly? Socialization of risk. Why should I suffer if I can contribute to a common space or common pool of fund where one company is ready to you know um and already or entitled to give damages, and there is pool of people, group of people, or a cooperative kind of system where all people will contribute for the same risk that they expect in their future, or contingent risk that they expect in future. It is called as a socialization or equally distribution of risk. Next is insurance company indemnify the losses of insured. So that's a very good thing. Like you can insure your washing machine, right? So you can buy washing machine and you can take if you pay 3,000 again, you can insure the washing machine. You can insure your TV. You can insure your iPad, right? Mobile, many more. So what is risk? What is risk? So no single definition for the term risk. So risk is uncertainty. Risk is what? Uncertainty. That we don't know what is going to happen. We don't know what is going to happen. So risk is defined as uncertainty concerning the occurrence of a loss. concerning the occurrence of a loss. So it is an uncertain event. Risk is an uncertain event. But we can predict risk. We can calculate risk. We can take calculated risk also. So that is what exactly we learned in management. How to take calculated risk. So insurance is the way that you can do business with a calculated risk. Have an example. Because of a COVID, it's a risk factor, right? Pandemic was a risk. Many company has shut down. Many small institution has been stopped function, right? So the economics and finance literature authors often make a distinction between risk and uncertainty. So the term risk is often used in situations where the probability of a possible outcomes can be estimated with some accuracy. With while uncertainty is used in situation where such probabilities cannot be estimated. Such probability cannot be estimated. So risk is an inevitable event. Inevitable event, right? Risk is an inevitable thing. Everywhere there is a risk. In the first slide itself, we learned that yesterday we learned that everyone that man has created, definitely there is a chance of you know obsolescence. There is a chance of you know dilapidation. So it is a risk due to you know due to time, due to weather, other reasons. Those things that man had made will be depreciated. So depreciation is also a risk, right? So we learned about VUCA time, right? We learned about VUCA time: volatile, uncertainty, then yeah, complexity, ambiguous. VUCA time. So VUCA time is itself a risk, right? So VUCA is what exactly? Volatile, volatile, then uncertain, complex, ambiguous. Okay, so in this situation, we are living in this situation. We don't know what would happen, and we don't have money to take lump sum of money to take, you know, to rectify this particular, you know, risk. Sometimes people doesn't have money to rectify those things, right? So insurance is the best means of tackle risk, right? So the potential loss that risk presents may be financial, physical, emotional loss also. So what is financial? We can measure that loss in terms of money. Is financial. Have an example. You send 100 kg of wheat. In between, while transit, there was a rain. The entire wheat has got wet, and it has perished. So it has both financial and physical loss, because wheat cost rupees for 1 kg, it costs rupees 100. So for 100 kg, it is 10,000 rupees loss in terms of finance, right? Physical loss turns to emotional also. If any a demise of a person definitely affect the entire family. So it is emotional as well as physical. So physical loss of a person, which always affect the financial thing. It is interrelated. So everything is interrelated. Okay. So loss or risk should can be presented in terms of financial, physical, and emotional. So we should be aware that insurers may use the word risk with other meanings, including like to signify the situation or premises or policyholder they are insuring. That means vehicle insurance. They will only call it as vehicle insurance. Okay. Property insurance or car insurance. They won't call it as a risk insurance, but there is a risk in property, there is a risk in vehicle, there is a risk in life, right? So you can see to indicate the peril or cause of loss insured. That means so some policy may insure on an all risk basis. So it indicate the peril, or peril means loss, or the cause of loss insured cause of loss. So it can be for the loss or the cause of loss. Have an example. Indicate the peril, that is loss. If a person dies, that is peril. Cause of loss, a person is affected with a cancer, that is cause of loss. For that also we have insurance. Cancer insurance is there, insurance policies are there. Understood? So that is what exactly called as a risk. So there are different categories of risk. Understand? Speculative or dynamic risk. What do you mean by speculative? Assumption. Speculative. No. Speculative games. No, stock market is speculative. That is assumption only. And dynamic risk. Dynamic risk is changing, right? Changing. So stock market is a best example of speculative or dynamic risk. Betting, investment, mutual funds, business is a speculative or dynamic. We don't know what would happen. So a situation in which either profit or loss is possible. So this risk is uninsurable with a few exceptions. This speculative insurance are, sometime it is uninsurable. Have an example. Wagering contract is not a contract. You learned about that, right? So speculative risk cannot be insured because it is sometime wagering. But business can be, even though there is an exception for speculative or dynamic risk. If it is business, it can be easily insured. It can be easily insured. But for a betting, you cannot do that. Have an example. Wagering contract. You are a jackpot sponsor, jackpot sponsor. That jackpot means the horse racing sponsor, and you have a horse also. Okay, you are one of the participant, and you done a wagering competition over there. If your horse wins, everyone has to give 1k pound, 1000 pound. Okay, and you have insured for any loss happen. If you lose that wagering, or if the horse lose that competition, the insurance company should have to give £20,000, and this is not a insurance contract. We learn insurance contract also. So betting or wagering cannot be put as a mutual funds. Cannot uh, we cannot take insurance for our stocks or mutual funds. No, we cannot do that. For debentures, no, we cannot do that. Next is pure or static risk. Static means stable. Stable. This risk can be very easily insurable. In short, so a situation in which there are only the possibility of loss or no loss, as opposed to loss or profit with speculative risk. Have an example: premature death, occupational disability, catastrophic medical expenses, damage to property due to fire, lightning, or flood, whatever it is, can be very easily we can insured. Next one is fundamental risk. What is fundamental risk? Certain basic factors are there. It can be very easily, it can be very easily insured. Okay, sometime like a war, unemployment, natural disaster, etc. Is a fact of a fundamental risk. Next is very particular risk like a theft, burglary, accident, house fire, dwelling fires, etc. It can be also insured. So you can see war. Definitely business may insure for this kind of a particular risk like a war. If a ship is transiting from India to China, so while at the Chinese nautical mile, India and China declare war. The ship has to be there. Ship cannot enter into the shore or port. What happens? Maybe some perishing items would be there. So definitely the shipping company should have to bear huge loss. At that time they can claim for a fundamental risk like war. So the ship company has to insure for that also. Okay, for that also, if war breaks up, I need this much of insurance. If my what are the laws, what are the accountable laws if I incurred due to the war, I need this much of insurance. So next one is subjective risk. What is subjective risk? Like subjective risk is defined as uncertainty based on a person's mental condition or state of mind. Drunk and driving, it is a subjective risk, but we cannot give insurance to that risk. We cannot give insurance to that risk. Have an example: A is a drunk and drive. A did a drunk and drive and hit B, and he run. A has ran away, and he had an insurance, accident, no vehicle insurance. Okay, third party insurance. A had third party insurance, but what happens at the time of test, blood test? It was proved that A had, had drunk. So he was coming from the way back to home after a booze party. Other evidence also subrogated with the blood test, and B has got a very huge damage because his thigh bone has broken. Who will pay? So here he has third party insurance, but insurance for subjective risk we cannot give insurance. This is subjective risk. I'm talking about risk only, not insurance. If you are doing, if we have any subjective risk, A cannot give damage from or A cannot ask the insurance company to indemnify to B because A is drunken. But B can directly claim damage from A. So that's what we are saying, like without insurance, don't take your bike outside or car outside. Or if you are drunken, sit at home. Don't, maybe some courageous may come that time. It is called as a Dutch courage. It is called as Dutch courage. Dutch. You will shout, you will get more courage, right? You wanted to be show off, so you will take the key and you will start riding. Not you, people. So what happened? The entire amount, maybe 50 lakh or 1 crore, you have to give as per the age of B. So if you are not drunken, definitely who will pay? The insurance company will pay. Next is objective risk. What is objective risk? So objective risk is defined as the relative variation of actual loss from expected loss. Actual defined as the relative variation of actual loss from expected loss. So actual loss is 30 rupees. Okay, expected loss was 50 rupees. Understood? So I have an example. Assume that a fire insurer has 5,000 houses insured over a long period, and on an average 1% or 50 houses are destroyed by fire each year. Sometimes 45 houses, that is 5 less or 10% variation. So objective risk declines as the number of exposure increases. Understood? So for a insurance company, they are running with a objective risk. Have an example. If I get 1 lakh fire insurance premium, okay, only it will be, incidents will take only for few, that is less than 5%. Less than 5%. If I get 2 lakh, the incidence will be, again it will come down 2%. If I get 10 lakh, again 0.5% will be the objective risk or payable risk the insurance company has to pay. It is called as objective risk. It is relative in nature. Next is dynamic risk, that we have learned already. Dynamic risk. So, changing economy includes changing taste of the consumer, technological change, new method of production, investment, goods, produce. Okay, so here we learned about the business, some wagering contract on all. So speculative or dynamic risk in terms of business or wagering or mutual funds. Here it is in terms of certain other situation, like political situation, in terms of technological situation, cultural, lifestyle situation, etc. Yeah, static risk we already learned. It is same as like a uh, you know pure risk. So it is part of these are the different. Yeah, financial risk is there. That means one where the outcome can be measured in terms of monetary, or pecuniary type. So pecuniary means money related, or monetary means money related. So financial risk. So financial losses, maybe have an example, due to theft or due to power cut or due to flood. Definitely you may, maybe like a car insurance, like have an example, for car insurance you have taken flood risk. Okay, so you have taken insurance based against flood. Okay, but what happens if it is a business? there is no damage physically happen at the time of flood, but in terms of finance, or in terms of monetary terms or pecuniary terms, the definitely business will affect with the flood. So that, for that, we can have a insurance which definitely compensate for our financial losses. Non financial risk, have an example, the great social decisions of life are example of non financial risk, like selection of career, choice of marriage partner, having children. So there are many or may not be financial implication, but in the main the outcome is not measurable but emotional. So there are some human criteria like emotions, motivations, etc. So the outcome could be uncomfortable or dislike in some other way. So for marriage we cannot take insurance, but it is a non financial risk. Non financial risk, if a marriage went on wrong, what happens? The entire and two family will suffer, right? But we cannot take cover it with a insurance policy. No, we cannot take a insurance policy for our career. We cannot do that. But I'm talking only about risk. If you lose a job, definitely you will get into depression. There is a financial risk, of course. There is a financial risk is also there, but you cannot take a insurance policy based on ambiguity or apprehension or a contingency of your career or marriage. But we have to know that there is a non financial risk, that is human based risk, that is like a psychographical risk or psychological risk. It will affect your motivation, it will affect your mental health, etc. So in the next class we'll learn about how to measure the risk. So thank you so much everyone.